Good afternoon, good morning, ladies and gentlemen, boys and girls, federal employees of all ages, wherever you may be. My name is Justin T. Pierce, and welcome to the most exhilarating hour of your day. I'm really excited to be joined by my colleague and my coworker, James Campbell. I'll be introducing him shortly, but I want to introduce myself to you first and let you know some housekeeping items as we teach you about your federal benefits in a very unique and innovative way. We're going to be talking about demystifying TSP today. We're going to spend a whole hour discussing TSP, the history, the funds, nuances, maximization strategies, all kinds of fun stuff. Plus, after the hour is up, you get to spend the next half hour with us, if you so desire, asking us questions, anything and everything. We're going to open up the Q&A in your bar at the bottom there. All right, it's not going to be open, or the chat is not going to be open yet. There'll be specific reasons we will open that up. We won't be able to answer anything until the end of the session. So for the next hour, we'll be making sure that we give you really good information in a fun and educational way. And after that, you got another 30 minutes. If you want, you can stick around. If not, get out of here. We know that you've got other things to do. So we're going to honor that and make sure that we get you out by the time that you need to be gone. So thank you so much. As I was saying, Justin Pierce, Federal Employee Benefit Advisors. I am a husband and a father, first and foremost. This is my wife, Rachel, and my 4 children, Allie, Zach, Maddie, and Lily. I used to live in Tucson, Arizona for the first 39 years of my life. Now I've lived in Charlotte, North Carolina area for the last 2 years of my life. And I am a financial fiduciary, first and foremost. This is very important to understand. There are a lot of financial planners out there. Most of them are not fiduciaries, okay? A fiduciary is someone who is held to the highest ethical and legal standard in this industry. And we are required by the SEC to put your needs ahead of our own and maintain no conflict of interest. That is a key phrase right there. I want to highlight that for a second. We are not employed by Edward Jones. We are not employed by Morgan Stanley. We don't work for one company. We're not getting a W-2 paycheck from one company like the majority of advisors are. Now, don't get me wrong, they're doing a good job. Most advisors do a very good job. But to remain independent allows us to remain conflict-free. So instead of just recommending one company's suite of products and solutions and maybe not having access to or not being able to show you what else is available in the entire universe of investments, being able to remain independent means that we can work with the top 50 financial institutions of our choosing. And then if we recommend something to you, we'd recommend the top 3 companies with the top 3 solutions at that time. That's how we maintain no conflict of interest. And folks, that is also how we're compensated, okay? So you don't pay us anything directly, okay? There is no fee for a consultation. As a client of ours, there is no fee for getting advice. There is no fee for future consultations. Beyond that, we are compensated directly by the financial institutions that we represent. So it is a win-win in that regard. This next phrase here, Federal Retirement Consultant, or FRC. This is a designation through FINRA, the Financial Regulatory Authority. Basically, it means that we're subject matter experts in this field for as it relates to benefits education and federal retirement planning. And this is a certification that needs to be done and re-upped with CE credits and continuing education each year. So I've got 16 years of experience working with federal employees, working exclusively with federal employees and their spouses. Started back in January of 2008. And we specialize in education. We are an education forward company. We want to make sure that we deliver workshops and seminars and webinars and lunch and learns. And then if there's a way that we can help you beyond that, then that's all the better. I'm the co-author of The Informed Fed that was co-written in 2019. James is going to tell you how you can get a free copy of that in just a minute. And finally, I am not a federal employee. No one who works with us is a federal employee. OPM has not contracted us. We are not compensated by any agency. Now, we're allowed to do what we do, of course, but we are not paid by, nor endorsed by, nor affiliated with the federal government. So I just want to make sure that you understand that. All right, so without further ado, I'm going to bring my friend and colleague, James Campbell, and he'll tell you a little bit about himself.
Well, hey, everybody, how you doing? Happy Thursday. Hope you're having a great week so far and that this weekend's got some exciting stuff for you to look forward to. But for today, we got some very exciting stuff teaching you all the ins and outs on your TSP. Looking forward to that. A little bit about me. My name is James Campbell. I live in Tucson, Arizona. Still, I didn't, ditch this place like some people I know. But love you, man. I'm also a financial fiduciary. I'm also a federal retirement consultant. So one of the things that is really interesting and good about this is that they test us annually. Not only did we do the coursework and the testing to gain that designation, every December, we get the distinct pleasure of taking that big old test again to show we're still experts, making sure we understand the changes that are coming down the pipe and all that kind of stuff. So really important. There's a lot of different people out there trying to pretend they're federal experts or think they're federal experts, but I always encourage people to look. They have any sort of a designation to prove that, and we do. Just like Justin and our whole team, I only work with federal employees or direct referrals from them. I also help put that in Form Fed. Like Justin said, I'm going to tell you in just a minute here how you can get a free digital copy of that. And also am not a federal employee, never have been. All right, we have a great team behind us. There are millions of you. So through the years, we've grown this wonderful team of people, and they have to be federal retirement consultants to work with us. So you know that anyone you talk to do a one-on-one consultation or stuff like that, they have that designation. We require that for them to work with us. We have just endless amount of people behind the scenes that make FEBA run. Some of the people that you might speak to, though, in scheduling an appointment or reminders, that kind of stuff, is like Donna, Simone, Joyce, Azra, Ashley. So a lot of great people, too many to mention, but we really, really love our team. We've got great people that work with us. Disclosures, this is pretty simple. We are going to be talking about investing today. But what we are not doing is giving anybody personalized investment advice. All right, we're going to talk in generality. We're going to talk, theory. We're going to talk about some potential strategies, but we cannot give you personal financial advice unless you engage with us and we learn about your situation, what your goals and objectives are. Then we can make recommendations for you. So please don't take anything as that. Justin and I are both licensed in multiple different financial industries. But once again, we're not giving anyone any investment, legal, tax, advice, stuff like that. All right. So how to get a free copy of the Informed Fed? It's very simple. You just schedule a one-on-one consultation with us, and these are free. And I can't say this enough. Every time that I talk on these webinars, I can't emphasize enough that taking advantage of a free one-on-one consultation is the best way to learn about your benefits, because you learn how this applies to you, what parts actually matter to you. We're throwing up a link in the chat. We're going to do that a few times through today's webinar. I highly encourage you to do that. When you do these, you're not just going to talk about TSP, you're going to talk about all 6 of your federal retirement benefits. And they're going to do projections and estimates for you to understand what's that going to look like when you get into retirement. All right. Upcoming educational events. We always have things on the horizon. We do a few of these per month.
This is an interactive environment, and we're going to be running poll questions and, like James was saying, pop quizzes. So just be prepared to take some notes, because you're going to get some pearls of wisdom, what we call federal secrets that maybe you haven't heard of before. Okay, that's the first objective. Second objective, we're going to talk to you about some ways that you can maximize TSP, not only with the balance that you have, not only with the contributions, the allocations that you have set forth, but also what you can do with TSP outside of TSP. So we're going to hit you on all angles and give you some things to think about and really help you understand TSP, understand its strengths, understand its limitations, but not only understand its limitations, but understand what to do with those limitations. It's one thing for someone to get up here and tell you how it works and why it's bad. It's another thing for someone to say, hey, here's why it's bad, or here's why it's good. Here are some options. So that's what we're going to do, give you some options. So before we do, let's start with some interaction. All right, so we're going to run a poll real quick. It's totally optional. It's totally anonymous. But the question is, do you have a financial advisor who focuses 100% of their time on serving federal employees? So let's go ahead and run that poll. This is very important to think about. There's tens of thousands of financial advisors in this country. And I would assume that most of them are very good. Most of them have a good grasp on the financial side of things, the investment side of things, how things work as it relates economically. But there are very few that can do all of that and know your federal benefits inside and out. When I started 16 years ago, I had to get very familiar with the Federal Employees Almanac. Do any of you remember that out there? That was the independent publication of a book, literally the size of the Old Testament. It's no longer in print. It was a really good book, but man, was that thing thick. That's what I had to know, study, and pass tests on before I could even start talking to federal employees. And of course, as things have changed, right, we've been on top of all of that. So when you're working with a financial advisor, it's great, but you have 6 federal benefits, 3 federal income streams that most financial planners don't really have intimate knowledge of. Now, they might have federal employees as their clients, but that's not who their majority is. Maybe a few, maybe a small percentage. But the folks that are teaching you things in these types of webinars need to be the ones. The way that you can determine someone who knows what they're talking about is when they're doing what James and I are doing, giving you the information and taking live questions. There's no time to go to GPT. There's no time to go back to someone who might know what they're talking about and then send you an email response. Those guys don't have the experience that we do. They don't have the knowledge that we do. So it's a very intimate relationship when you can bring the financial and the federal side together, and we can make recommendations to you, put you into maximization strategies that I guarantee you most financial advisors have no idea even exists. So let's take a look at the poll and see where everybody's at. Okay, 91% don't, and the remaining 9% do. That's right around what we see, usually around 90-10. So those of you that do likely are probably our clients. No, I'm just kidding. But I'm glad that, you guys do have a federally focused advisor. And those that don't, this is your opportunity to understand what it looks like to work with someone who knows both sides of the spectrum. So thank you for participating.
Before we dive into this, it's really important to understand a couple things on why we emphasize TSP so much. When you think about your pension and your Social Security, they're very similar in the fact that they're both annuitized payments, meaning those are going to pay you every month for the rest of your life. These were involuntary programs. You didn't get to choose how much you participate in the pension or Social Security. They just took the deduction out of your paycheck, if you like it or not. They're both going to cost of living adjust for you. There's nothing you have to do for that. There's nothing you do to make it better. They're going to tell you when and how much of a pay raise you're going to get on that. And lastly, those 2 pots of money are illiquid. You cannot touch the balance. You can't call up OPM and say, hey, I want to go on a vacation. Send me an extra $5,000. The answer is no every time. Just no, you're going to get your monthly paycheck. That's what it is. Okay. With TSP, it is completely opposite. You have so much control over this. With your TSP, you choose if and how much you participate. Beyond that, you've been making the investment decisions on this and will continue to do that. So you have a direct impact on how this money grows towards retirement and in retirement. Nobody's going to give you a cost of living adjustment on your TSP. You have to invest it properly so that you can pay yourself that cost of living adjustment without running out of money before you run out of years. You decide when and how much to pay yourself on TSP. All right. And it is fully liquid. So it might not be a good idea, but you can pull any amount of money at any time to go do whatever you want with it. So we're talking about complete control, indefinite decisions from here forward on your TSP. That's why we are so passionate about TSP. That's why we spend so much time teaching about TSP. One other thing to understand about TSP before we dive into the history of it. It is just another financial tool. There are hundreds and thousands of different financial tools out there. They're all in different shapes and sizes. They're all built to do different jobs, but we know no one financial tool is built to do all jobs. So anytime you have access to any particular financial tool, it is imperative that you understand what is this tool built to do? What jobs is it good at? What jobs is it not good at? And you want to use it accordingly. So that's what we're going to do through today's webinar is teach you the structure of TSP. What are its strengths? What are its weaknesses? How do you want to use it? How can you maximize it? All right, let's dive into the history of TSP real quick. So in 1986, the Federal Employee Retirement System Act was signed into law. So TSP was born. It actually went active in 1987 with one fund. That was the G fund. Not a lot of diversification there. 1988, not too much later, they added in C fund and F fund to give you some stock and bond exposure. Then in 2001, they further opened up more indexes with the S and the I fund. 2005, they added the life cycle funds. So life cycle funds are what they call target date investment funds in the private sector. 2012, this was a big change. They added in Roth, and this is great. This is one of the big advantages of TSP is you can start to retirement tax plan while you work. Traditional Roth are both great strategies. They're just different, so we can talk more about that. In 2019, there was a massive change. It was called the TSP Modernization Act. What I tell people is that basically they took TSP from being a fossilized dinosaur in the 401k world and brought it up to just being slightly out of date. But a lot of big changes and some very good changes happened in 2019 that we'll talk some more about. All right, so there's a few things that TSP is really good at. All right, and here's how we want to use it. Contributions is one of them. So if you're a FERS employee, you get that matching contribution up to 5% of every paycheck. This is huge, huge advantage. Another thing that happens as an advantage to TSP or any other 401k structures, when you purchase shares consistently, regularly, it creates something called dollar cost averaging. You don't have to think about this. It's already baked into the cake. It's already part of the system, but it's an advantage to being able to participate in an employer-sponsored plan like this. Contribution limits are now another big advantage. There are huge contribution limits to TSP, way more than you can put into an individual contributory account. So that really lets you sock away some money, especially when you're 50 and older, towards retirement. That's another great advantage to TSP. And like we talked about, you've got both traditional and Roth. That's a great advantage. All right, so the TSP Modernization Act shook things up quite a bit. One of the big things they did was change the RMD rules. Prior to 2019, when you hit 70 and a half, they showed you the door. They said, we're done with you. You need to take your money somewhere else, because TSP did not want to deal with the IRS and their required minimum distributions, which I find absolutely hilarious. No offense to you, IRS folks. We love you. Someone's got to fund this country. It's just comical to me that they didn't want to deal with RMD, so they kicked people out. And years ago, back when it first started, when you retired, you either selected a structured payment or you had to get out. After 2019, there is no more end date. You can stay inside TSP for as long as you live, but we're going to get into some reasons on what it's probably not the best idea, at least not completely. Anyhow, withdrawal options for post-retirement, they changed some of these, added in some more rules. It was pretty restrictive on how you could take withdrawals. It's still pretty restrictive, but there's more options than there used to be. Partial withdrawal rules changed. So this is one of the big things, and we're going to touch on this later. This absolutely revolutionized how people can prepare for the income phase while they're still working. TSP considers anyone that's 59 and a half or older to be pre-retirement. And post-2019, they gave you a lot of more flexibility to gain access to more financial tools while you're still working, so you start preparing for that income phase. And Justin's going to talk to you more about that in TSP maximization. That was the biggest thing that happened for pre-retirees in that TSP.
Thanks, James. Really good information, folks. That's sort of the cornerstone that you need to understand as we start talking about how we can maximize it. And we're going to give you some illustrations and some opportunities for you to understand ways that you can take advantage of some of the pitfalls, take advantage of some of the loopholes, and then maximize it as it relates to your investment strategy. So just again, we're going to send in to the chat a opportunity for you to request a appointment with us. And again, if you do that, you're going to get a digital copy of our book, The Informed Fed. It's complimentary. We're not going to try and pressure you into anything. We're going to do exactly what the screen says, do a thorough in-depth analysis on your 6 main benefits, project incomes, talk to you about your situation, understand your needs, your horizons, and then let you know what we might be able to do as it relates to maximization strategies, federal secrets, things of that nature. So before we start with TSP maximization, I've seen a lot of people join after I started telling you about the housekeeping stuff. So the Q&A will be starting right at 2 o'clock Eastern for the next 30 minutes after that. So if you have time, you want to ask some questions in the Q&A, you can type them in now if you want. You can type them in later. We'll get to those at 2 o'clock Eastern. So the question, or the poll question here is, regarding your TSP, what matters to you more? Maximizing your returns, which is being aggressive, or maximizing losses, which of course is being conservative? So let's go and throw that poll up. So in financial terms, especially investment risk tolerance, right? Generally, when you're younger, you can take more risk. When you're older, you shouldn't take as much risk, right? That's the general boilerplate sort of recommendation. Everybody's different though. Some people who are really young want to take absolutely no risk, and some people who are already in retirement have no problem being 100% in the C fund. Okay, so to each his own. But we're going to be talking about traditional recommendations, things that we recommend based on studies that we've seen, based on research that is out there. Okay, so let's go ahead and run the poll. I would imagine it's probably going to be somewhere around 50-50, 60-40, something like that. And yeah, 54% aggressive, 46% conservative, right in that sort of range that we were talking about. Okay, so now we understand risk tolerance a little bit. Let's talk about TSP maximization. So this is a really interesting concept that James and I have kind of coined here, TSP maximization. So just a quick review. Here are those funds again that he was talking about, all right? So again, the main advantage of the TSP is the 5% match. That's the main advantage. There are other little ancillary advantages, but that's the main one. So CSRs, folks, sorry, you don't get that. You do get a much higher pension, so that's worth it as well. But for FERS employees, take advantage of that. If you're not, definitely do. It's called an incentive to invest. There's a very small fee tied to TSP. So that's also something that you should be aware of. It's a very limited plan, so it's a very small fee, but that incentive to invest is huge, that 5% match. The disadvantage to the TSP are the 5 funds that you're looking at. You only have 5 to choose from, but in reality, you only have 3 choices. And that's because 3 of the 5 are the same exact thing, the stock market. The C, S, and I are correlated assets, meaning they're moving in the same direction depending on the market's movement. So if the market's down, all 3 are down. If the market's up, all 3 are up. This is called a systemic risk, right? So you've got the same asset class, stocks. So you really only have one choice. They might get a different rate of return, but they're still moving in the same direction. So therefore, it's the same choice. It's highly correlated. Then you've got the bonds, the F fund, like he explained. And to be honest with you, the F fund, the bonds haven't really been doing as well as they should over the past 10 to 15 years. There's a couple studies that have come out that have actually proven this. The F fund in particular, because of the way that it's constructed, the way that James kind of described it being sort of like a stock index, has not been doing well at all. Over the last 10 years, the average rate of return in the F fund is just over 2%. And it is correlated with the market when it shouldn't be. As an example, 2022, the stocks were down double digits, 18 to 26% in the red. The F fund was down 12.83%. That's almost 13% loss. That shouldn't be happening in a bond fund. That shouldn't be happening in a fixed income account, okay? So we're not a big fan of the F fund, not at all, right? And then you've got the G fund, which is your third option. This is your conservative retirement account, right? I'll talk more about that guy in a second, but here's ultimately the premise of TSP maximization. If you are in the retirement horizon, someone who is 59 and a half or older, someone who is ready to retire within 5 years, right? If you're 57 and you've got the 30 years and you're going to retire in a couple of years, you're in the retirement horizon. If you're 59 and a half or older, you're in the retirement horizon. Someone who is in the retirement horizon has a disadvantage by being in the TSP. And that's because you have 3 choices. And I'll explain why in just a minute or two. But first, understand that when you're younger, it's okay to have TSP. The TSP is a savings plan. It's designed for younger employees that are coming up in their career. And we know this because of the funds that you can choose from. You've got stocks, bonds, and cash, right? So when you're younger, you can get most of your return in the stock market. And we love the stock market because it has an average rate of return of about 10%, right? The C fund since inception is just over 10% average rate of return, but it takes decades of time to get there. So when you're younger, you have time on your side. You can be more aggressive. You can go through an 02 or an 08 financial downturn, right? You can lose 25 to 40% of your portfolio, and it doesn't feel good. It doesn't look good on paper, but you're not going to be liquidating those shares. You're not going to be retiring soon. You're not going to be generating income out of that balance. You've got 10, 15, 20 years or more before you need to pull that money out. And eventually 10, 15, 20 years or more, that stock market will come back, usually sooner than that, but about 7 to 10 years with major downturns. So when you're younger, you can be in the stocks and now the F fund with its double-digit losses. But when you get into the retirement horizon, all of that changes, right? You no longer have time on your side. You can't outlast those big market corrections. And this is why investment philosophy dictates that we get much more conservative the closer we get to retirement. Modern portfolio theory, which is a Pulitzer Prize-winning thesis developed in the early 80s, took a lot of data analysis and a lot of research on aggressive investments, conservative investments, moderate investments, and they determined that the closer you get to retirement, the more conservative you should get, because that means your retirement income stream is going to be more predictable, more reliable. And as an example, if you're in the stock market, right, and let's say you just retired and you're going to take 5% out for your retirement income stream. That's the kind of the national average for retirement income streams. It's also what the IRS on average is requiring for RMDs at age 73. So if you're taking 5% out and the market goes down 20%, you just liquidated 5% of the balance at a 20% loss. You're never getting that money back. The balance is permanently depleted. This is a fast way to potentially run out of money if you keep pulling money out when the market's down, okay? So then what do, right? Okay, well, let's get more conservative. So let's follow professional investment philosophy. So let's shift more of the money into our safe asset classes. This is the problem with the TSP. You only have one, that's the G fund. That's the only fund that guarantees no losses. We've already established that the other four have lost double digits as recently as 2 years ago. So when the G fund is your only option, that's a bad thing. We like the G fund because it guarantees no losses, and it has been since 1987, but the average rate of return over the past 10 to 15 years has been about 2% for the G fund, and it's not getting much better. So when you're only averaging 2% and inflation 6%, then you're going to suffer from inflationary loss, and that's a big deal. Okay, that'll really bring down the value of the portfolio, not the balance, right? You don't see it on a statement. You don't see the red number on the online account. You see it in what you're purchasing and how much you can or cannot purchase. So the value becomes worth less the more you suffer from inflationary loss. So if inflation's 6% and you're only making 2%, your value is going down 4% at least each year. Okay, that's the first problem. The second problem is that this is the government's account. This is the G fund, government securities. This means the government has autonomy over this account. And when the government has autonomy over giant pools of money, we know what the government does. Okay, this is where I'm going to shoot straight with you. The government is meddling in this account. They're doing things in this account that are raising a lot of eyebrows. Since 2017, Uncle Sam has been borrowing from the G fund. Now, they only did it for a few years, then they stopped. But last year, between February and June, they divested everybody out of the G fund. I don't know if you are aware of this or not. It wasn't widely advertised, but Treasury Secretary Yellen did exactly this. All new contributions going into the G fund starting in February were not going into the G fund. They were diverted to an escrow account for more borrowing for the federal government. And think about why, right? We're almost $34 trillion in debt now. We're paying $1 trillion of interest each year on our debt. We're sending billions and billions and billions of dollars to countries across the world. We're printing money left and right. Inflation is out of control. So they're looking for money. So they divested everybody out of the G fund so that what that means is all the dollars that were going into the G fund were not actually going into the G fund. They were going into that escrow account. But here's the problem. On your statement, on your online screen, it looked like your balance was going up. And that's because it was illusionary. These were IOUs. Okay, it was an accounting shell game. They were showing you what they promised to pay you back if and when Congress raised the federal debt ceiling, which in June, early June, they did, thankfully. I never thought I would say that, thankfully, that they raised the debt ceiling, but they did, so they paid everybody back. Here's the other problem. The interest that was earned in the account that you saw, the small amount that was going up because of interest, same thing, it wasn't real, it was illusionary. So all of it was paid back, which is good, but can you imagine if your bank was doing this to you or your IRA account was doing this to you? So I say that because G fund is not as safe as people think, okay? And the federal pension system was no different. It was under insolvency, and they had to make changes to it back in 2012. And the Social Security system is in the same boat, almost, defunct, being almost, out of commission, if you will. So when you've got one option that is safe and you've got four options that are high risk, you're in a tough spot. So this is where TSP maximization comes in. So I'm about to introduce it to you. So before that, though, this is another reason why you really want to be out of the market, at least the majority of your portfolio, right? When you're aggressive or when you're about ready to retire, you want about 60 to 80 to 90% of your assets conservative, depending on how much risk you want to take. Okay, generally 70 to 90%, right? As you enter the retirement horizon. And this is one of the reasons why. Not only are there two major normal, big downturns, about 20 to 30% per downturn almost every decade. There's been a couple anomalies where that did not happen, but almost every decade since the Great Depression, we've seen two major downturns every decade. These are historical bear markets. These are over and above that. Okay, so this is why you want to be careful, and this is why we're recommending right now that folks really be careful with what's going on in our world, what's going on in our country, with what the government is doing, with the knuckleheads on Capitol Hill. Not you guys, right? We're talking about the people that are the puppet masters. What's going on with the financial system, with the money system, right? We've already had the biggest loss in the S&P 500 2 days ago since March of 2023. So it's going to be a wild ride, and I want you to be prepared for that, okay? So then you're like, okay, well, what do we do, right? We know the G fund is our only safe option. Stocks and bonds are volatile. What do we do? Well, when you're 59 and a half or older, or if you're separated service, you can do what James was talking about, which is a TSP in-service withdrawal or rollover to a qualified account or an IRA. There's no taxes, there's no penalties, there's no fees. As long as you qualify, you could do this and you should do this, all right? Depending on the investment that you put it in, right? That's up for debate and up for you to decide. But the process of transferring it to an IRA is I would say almost every financial planner in the country would say that's a good idea because of the limitations we know TSP has, right? Because all you've got is the G as your safe haven. So here are some of your core options, right? On the left side are more aggressive, higher risk. When you're younger, maybe you're 40 years old and you've got another 401k from another company, you might want to do something into an IRA because that 401k is not much different than TSP, stocks, bonds, and cash. That's all you probably have with them too, okay? So you've got, stocks, mutual funds, things of that nature, but you also have a big potential of loss. So on the other side of the triangle here, when you're in the retirement horizon, you've got the conservative side. But the problem in our country is we've got hundreds and hundreds of high risk, aggressive investments. Almost every week a new one comes out, but we don't have any really good conservative ones that protect from loss and offer good rates of return that can exceed inflation or at least match inflation. That is, except for one option. And that's what we're going to talk to you about today. And we're going to ask you to consider it, right? And sit down with us and talk about it before you decide, of course. But it's called the fixed indexed annuity, the FIA. Okay, your broker isn't going to show you this. It's a competitive feature to them. Okay, this is from an insurance company, an annuity company. Brokerages are different than them. They're competitive. Okay, mainstream traditional financial planners build portfolios off of stocks, bonds, and cash, or mutual funds, which is a combination of all three. I'm going to show you something totally different. James and I are outside the box. We're holistic financial planners. We do what we feel is the best option, not what we've just been trained on. Okay, so the fixed indexed annuity is very popular for two reasons. First of all, I want you to understand it's an extremely popular investment. Okay, it has been compared to bonds in a couple of studies, one done by Yale, one done by Barclays, and it's shown that it is a much better option than bonds, okay? And bonds used to be considered the gold standard of conservative investing, mind you. Remember, that's how traditional planners build those portfolios, stocks and bonds, bonds conservative, stocks risky. So this is much better than that. So for the first reason why the fixed indexed annuity is so popular is because it's guaranteed not to lose value. Now, let me first say that sometimes the word annuity can be the elephant in the room. So let me explain to you why the word annuity is here. Because you've heard about this annuity, that annuity. There's lots of different types of annuities. There's good ones, there's bad ones. This is a great one. But what this is not is a traditional annuity where you take a balance, you turn it over to the insurance company. In exchange, they pay you a monthly income for the rest of your life. Guaranteed. That's really nice. However, you lose all access to the rest of the balance. And if you pass away, some or all of the money does not go to your beneficiaries. Let me introduce you to the FERS pension. That is an annuity. It's called a FERS annuity. A FERS annuity, okay? That is not what this is. The word annuity in the phrase fixed indexed annuity is a choice. It's an option to annuitize. You may turn it into a pension. You may get that guaranteed monthly income, but we don't advise it because of the limitations that I just mentioned. The other choice you have in a fixed indexed annuity is to just simply withdraw the money when you want, how you want. Okay, taking the money out kind of like a TSP or an IRA. All right, so you've got choice. The annuity part of it is a choice, not a requirement. All right, so now that I set the record straight there, the FIA has been around since 1995, and it's never lost money due to market volatility. Never once. It's guaranteed, contractually obligated to never have a loss. I have hundreds of clients. I started in January of 08. I had about 15 clients who had FIAs by the end of the summer once the financial collapse kind of hit the high point there. None of them lost a dime. They're designed not to. It's physically impossible for the insurance and annuity companies to lose money the way that they do the investing. And we can talk about that on a one-on-one consultation. It's not possible. They can't lose money, okay? They're actually investing on your behalf. Your money is never at risk. It's a beautiful thing, okay? So they guarantee no losses. So that's the first advantage. The second advantage is that they're indirectly tied to stock, professionally managed index funds, okay? So take the C fund as an example, the S&P 500 replica, right? So when you're investing in the C fund, you're investing 100% of your money in the C fund. So if the C fund is up, you get 100% of the return. If the C fund's down, you get 100% of the loss. That's called 100% participation, okay? The indexes now have their own versions of the C fund. They've got proprietary stock indexes, but not only that, they're professionally managed. So these big fund managers like Janus and Barclays and UBS and Goldman Sachs, they're working in conjunction with these annuity companies, and what they're able to do is enhance the performance of the portfolio. So not only are you getting most of the return when the market's up, when the fund is up, but as an example of what enhancing a portfolio might look like, let's talk about UBS. They've been around for 160 years. They're one of the top fund managers in the world. Their fund, with the company they're working with, has an options strategy. And quite simply, options allow the traders to potentially get a positive return in a flat market or slightly down market. It doesn't always work out, but sometimes it does. You're guaranteed not to lose, but sometimes you can make money when everybody else is losing in the C fund. Okay, that's an example of professional management. Sometimes these returns can be as high as 25 to 30%. We have actual performance data that will show you that this has happened in the past, okay? And it can happen again in the future. So in an FIA, you get most of the return, not all of it, right? It's called the participation rate is called majority. So in an example, let's say it's a 20% return. Hypothetically, you get a 17% of that. So the insurance company keeps 3%. That's an example of majority participation rate. So they take a little off the top, but in exchange, you get none of the losses. All right. And this is why we recommend the C fund. If you're in the stocks, this is why we recommend the C fund over the S and the I. Same concept, okay, as it relates to not having as many losses versus having bigger gains. And here's what I mean by that. The C and the S and the I are correlated. They're moving in the same direction, but the C is far superior to all three. Definitely the I. As an example, since inception, the I fund has averaged just under, I think it's just under 5%. Let me look at my notes here. No, it's just over 5%, 5.05%. The C fund has averaged 10.96%. So the C fund has doubled the rate of the return than the I fund, yet some advisors are recommending people diversify their stock positions and put it in the I fund. You're diversifying it into something that isn't diversifiable because it's going in the same direction and it's twice as bad. So if you're in the C and the S and the I, first recommendation here to maximize your TSP allocations is to shift into the C. And the reason why is because the volatility index is lower. It's a more conservative account. It's the bigger companies. They have lower losses. They might not make the bigger return like the S fund or the I fund can, which happens once or twice, every couple decades, but they're not going to have as big as losses. Here are two examples. March of 2022, or I'm sorry, March of 2020 because of COVID, right? The C fund was down 12% that month. The S fund was down 20%. In 2022, the C fund was down 18%. The S fund was down 26%. Not having as big of losses is more important than maximizing the return. And that's why the FIA shines, because not only are you going to get a really good rate of return, averaging about 8%, some of them are averaging close to 10% over the last 10 years. Some of the ones that we work with are on the higher end like that, but on average, it's about 8%. But you're not going to have any of the losses, and it's contractually guaranteed. So the high growth potential is really where it's at, because now you don't have to worry about the G fund making 2%, and inflation is eating into that. Now you don't have to worry about the stock market going like this right before retirement or during retirement. The other nice thing about the FI is that they're very low fee, okay? Usually on average about less than 1% as it relates to their fee. So it's not too far off from professional money management. Usually professional money management is anywhere from 1% to 2%, but they can't guarantee things the way that the FIA can. Let me give you an example of some of the indexes. Okay, so these are some of the professionally managed indexes that are available in the FIAs. And we work with the top 50 out of the 847 insurance companies that offer FIAs. We work with the top 50. Of the top 50, each one has about 3 to 10 of their own proprietary indexes. Okay, that equals about 5,000. We work with the top 3 of those 5,000 indexes. All right, so we've got access to the best of the best. So think about what I want you to do as it relates to the FIAs. Think about it in the world of TSP. Imagine taking your C fund and then taking your G fund and combining them together to create one account. That's sort of like the FIA, so that when the market's doing well, you're getting good returns close to the C fund average, right? But when the market's doing poorly, you get the guarantee of no loss offered by the G fund. It's kind of like a perfect hybrid blend, okay? And then you've got professional management on top of that, enhancing the portfolio. So I want to end with this, and it gets better, okay? Right now, annuity companies are offering some great incentives to become clients of theirs, okay? And the first incentive is very similar to what you're getting right now with TSP. Some of the companies are offering a match. 2 of the top 3 that are in the industry are offering a 10% match. So every dime you transfer out of TSP after 59 and a half, or after retirement, whenever you're eligible to do this transfer, there's no taxes, there's no penalties, there's no fees to do the transfer to the IRA. The annuity company will give you 10% cash bonus on top of that. So if it's 100,000, now you've got 110,000 day one. And that's important to understand, because then the balance is going to be high instantly. So whatever the rate of return is, it's going to compound on a much higher balance. The other nice thing about the FI is that it's got the capability to offer you an option for a guaranteed interest rate year over year. Sometimes it's very low, sometimes it's very high, like it is right now. So right now the average is between 5 and 5.7%. So let's think about that for a second. You took 100,000, transferred it to the FI, you made 10,000 instantly. Then the insurance company guaranteed you 5.7% on top of that. So you're making 15.7% on the money in the very first year. It would take the G fund 8 years to make 15.7% on the money based on its historical return over the last 10 to 15 years. Okay, so in essence, the FIA is a great alternative. It's a great way to maximize your TSP. With the funds that it's not perfect. It's got a limitation. And we talked about the fee. We'll talk about the limitation when we meet with you one-on-one. Okay, I'm not trying to say that this is the end-all be-all, right? One of the number one questions I hear is, it sounds too good to be true. It's not. Okay, there is a limitation. We'll talk about that. So don't feel like you're stepping into something that that you're not going to know about. We're going to go into great detail, giving you good information, research, articles. We'll show you some performance reports from the top companies. So the transferring assets from a dormant 401k, if you're younger and you've got an IRA, if you're older and you've got other IRAs, we can work with other assets as well. It's not just TSP. Okay, so thank you very much for your time, folks. I'm going to turn it back to James, and I'll see you at the Q&A.
Thanks, Justin. All right, so like you said, I'm going to touch more on these life cycle funds and kind of the limitations to them and how you can actually create your own in a more maximized fashion, now that we understand these different fund options, now that we really understand these 5 fund options. All right, so this one actually, we accidentally threw in an old one. This is from 2023, so this is adjusted. Let's talk real quick about target date investment funds and the life cycle funds. So target date investing is when you just choose a future retirement date and you let the employer, or in this case, BlackRock and the Thrift Board, adjust those allocations for you. They're simply going to follow investment, traditional investment advice. The further you are from that date, the more risk it takes. The closer you get to that date, the less risk it takes. All right, so this was last year. And if you were in the L 2025, this is someone that's getting ready to retire next year, or approximately that. I'll go back to that last slide there. Then they had about 55.5% in the G fund. Now this year, it's a little over, it's almost 62%. So what you have to realize here is, when you get within that 10-year time frame of retirement, it's going to pretty rapidly de-risk your portfolio. And like Justin taught us so well, there is no other way to de-risk other than to shove more and more money into the G fund. All right. And then when you hit a target date on a life cycle fund, it gets automatically absorbed by the L income fund. This is the only quasi recommendation of TSP. If you're going to use it as an income source, then the L income fund is what they would say is the most appropriate. Now, right now, the L income fund has about 70% of the money in the G fund. All right. Beyond that, like Justin talked about, it's going to have F fund allocation. The life cycle funds, for some reason, really heavily like the I fund, and we're not sure why. So how can you do this but better? They're telling us, what is a recommended amount of downside support if you're getting close to retirement. That's all great and dandy. But now that we know if you're 59 and a half and older, you don't have to keep inside TSP up to 4 times per year. You can roll that money with no fees, no taxes. You can roll that money to outside IRAs to gain access to more tools. And like he talked about, one of our favorite downside protected tools is FIA. So let's look at, for someone that's 59 and a half and older and close to retirement, let's look at the next slide and see what, an L fund maximization, as we call it, would be. Well, it's pretty simple. Just what you would put into the G fund, slide that over to the FIA, get the match, get, the guaranteed rate of return for the first year, potential double-digit growth going long-term. And what stays inside TSP, we want to use what they're best at. And history says the C fund is what they're best at. This gives you a nice mix between downside exposure and protected. And it's going to perform incredibly superior to a regular L income fund, because you don't have 70% of your money getting beat up by inflation on most years. You have 70% of your money getting a much higher average. Like Justin said, most of the top companies are going to show about an 8% average over the last 10 years. So that is an L fund maximization for somebody closer to retirement. Now, an L fund maximization for someone that's younger is simply to look at, how far from retirement am I? How much, do I want to take risk? And one of the quick, easy ways you can do is look at the L fund that would be the closest to when you would retire. Anything that's G and F, put it in the G. Anything that's CS and I, you can put it into the C. And that's a way where he talked about, you can build your own custom L fund that just by the historic numbers is going to perform better than the way that they spread it out between the 5. Anyhow, now let's talk to those people that are more risky, or those people that want the money that stays with market exposure to be more diverse than just the C fund. So that's something that we call non-correlated asset allocation. And this is something that we can help you with. With professionally managed funds, you can spread your net a lot wider. When you get into a bunch of different types of asset classes, it reduces the overall volatility. Therefore, it can allow for a stronger long-term rate of return. That is what non-correlated asset allocation is. And that is all derived from modern portfolio theory, which was a Pulitzer Prize winning thesis in the 1980s. Pretty much all modern investment advice is based off of modern portfolio theory. So we talk about getting into not just C fund or CS and I, we talk about getting into real estate investments, commodities, gold, silver. We can get into inflation protected securities. We can get into actual bonds, actually purchasing and owning bonds, which is completely different from owning shares of a bond index like the F fund. When you diversify out like that, it's going to give you more stability and a better overall rate of return. And it's just not even fair when you compare, a professionally managed portfolio with thrift savings plan. So Justin and I are both licensed registered investment advisor representatives. We can work at any level of managed money that you want. We can help with. And well, it looks like we lost Justin. So we'll see if he pops back on. He's continuing to have technical difficulties, but that's okay. If he doesn't come back, I'll just run this out the rest on my own. So this is also something that can happen. You can end up with a 2 or 3 tier strategy, depending on what you want. When you get 59 and a half and older, and those chains come off, and you're free to keep using TSP for what it's best at and not to use TSP for what it's not good at, that creates that TSP maximization strategies that we've talked about for the pre-retirees. And that involves continuing to use TSP, new contributions, government match, large contribution limits, got Roth and traditional that you can choose from. And C fund is what the TSP is very, very good at. We want to keep using it for that. But anything that we don't want in that structure, up to 4 times per year, you can roll money out into outside IRAs and gain access to any financial tool that you want. We tend to use FIAs a lot for the downside protected portion. But what about the people that are like, great, I want a little bit of that, but I actually want a lot more, risk. I want to be able to invest into, specifically, what if I want to invest into Amazon or Apple? You can't do that inside TSP. So some people will be very savvy, and they'll be utilizing FIAs for the downside protected, TSP for the new contributions and government match, and everything else they're rolling into a managed portfolio that we can put into any type of investment under the sun. All right. So you can be as simple or as complex as you want to when it comes to TSP maximization. When you're under 59 and a half, you're just looking at, using the best funds available and adjusting your risk tolerance according to your age and what kind of a risk you're willing to take. But when you're 59 and a half and older, like I said, the gloves are off. You have so many tools available to you. We'd love to chat with you and start coming up with a plan on how you can start using some of these other tools to maximize your overall portfolio as a whole. Now, let's talk about bear markets. And this is a really good graphical depiction why it's so important when you're within 10 years to start focusing more and more on downside preservation. This is why Warren Buffett says, if you can't forget that those dollars exist for the next 10 years, don't put them in the stock market. I'm specifically speaking to those of you that are getting close to retirement. If you're younger, you don't need to try to respond to the market. History tells us you're going to be fine if you got more than a decade. But I want to talk about the difference in bear markets. They're not all created equal. Okay. We all remember 2020, when COVID hit. That was what was called a V correction. That's like the best case scenario. It lost 35% in a matter of a couple of weeks, and it was a pretty wild ride. But it snapped back so quickly because the Fed stepped in, slashed interest rates to zero. That was combined with a bunch of optimism. And 2020, when it should have, by technical standards, it should have been a loss year, right? Everything was shut down for part of the year. But 2020 was actually a gain year in the markets. It didn't make sense necessarily, but it's what happened. So that V correction is one of those where if you just close your eyes, take a couple of deep breaths, you're made whole again. But it doesn't always work like that. And we've kind of been conditioned to forget that these longer term, bear markets or longer term downturns can happen. So let's look at the S&P 500. And specifically what we're going to look at is the dot-com bubble burst. So in June of 2000, the S&P 500 peaked. As you can see, it had never been higher. And then the bubble burst. And then there was a correction in 2000. Then it started coming back. And then 2002, we had another correction. And then it had a few good years, and it actually kissed that record high again. And then 2008 happened, the Great Recession. It never fully recovered to this level, this June 2000 level. It never recovered and stabilized until December of 2012. It was a 12-and-a-half-year recovery. Some of you may know people that had to delay retirement, or they did retire during this period, and it was hard because they're having to spend down larger percentages of their balance because they're having to pull incomes from bruised accounts, and they just wouldn't quite recover and come back. We don't want that to happen to our clients. That's why we teach the proper amount of support, the proper amount of downside support mixed with some aggression. But we want to be well balanced. Okay, depending on your risk tolerance is going to depict what percentage should be downside protected, which percentage should be aggressive. All right, so we're going to start to wrap this up, and here in a few minutes, I'm going to switch to doing the Q&A. Justin has still not come back online. That technical difficulty seems to be a little longer than we were thinking, but either way, I'm gonna hang in and do these Q&As for that 30 minutes. Just another reminder, we're going to throw another link in the chat. Please engage with us. It's free. I promise we're nice. I'm not aware of any of our people that bite or that are rude or mean. We're all friendly people. We know your benefits inside and out. And if this, last hour hasn't shown you how important it is to talk to someone that truly understands your federal retirement structure, I don't know what will. But talking to one of us is one of the best things you can do to really start to understand all 6 of your federal retirement benefits. All right, remember, upcoming educational events. Some more links are coming into the chat. Unlock the secrets of your federal retirement. This is going to be the overview of all 6. Folks, we say this at the end of every webinar. Our main goal is to serve you better. We love serving federal employees. We appreciate you. You keep this country running. We want to serve you better. One of the ways you can help us is fill out our survey. We want to know what we do good. We want to know what we could do better. We want to know if our hair looks funny or something. Whatever you want to tell us, we appreciate it. And we'll send you a free publication, The Top 10 Mistakes Made by Federal Employees, if you participate in that survey. And that wraps it up. So if you're someone that needs to get back to work, we're exactly on the hour as we promised. We got all the new information out in exactly 60 minutes. But now for those that do want to hang out, you can start to throw those questions in the Q&A. It has been open this whole time, so I've got a backlog of questions, and I'm just going to start at the beginning and go through them. Justin's still not back. It might have been a bigger technical issue than we thought. So that means it's going to go a little bit slow. Normally, one of us can pre-read the question while the other one's answering one. I'm going to have to take a second and read it, make sure it's appropriate for everyone in a group forum, and then I'll read it. Just so you know, I'm not going to say anyone's full name. I will only address you by your first name. If you prefer to not even have that, put that in your message, and I won't even say your first name. But let's get started on the Q&A. Okay. Okay. Yes, this is a great question. Jeff says, turn 60 next week, want to retire this year. I'm concerned about losing what I have before the end of the year because of the election, state of the economy, etc. Is there anything I could do to ensure it does not go down? Yes. The most immediate thing you can do is do an inter-fund transfer to the G fund. If that is your concern, then you can move your whole balance to the G fund and it is fully downside protected. There is no market risk there. And then I would say, as soon as possible, get on our schedules. We'll talk to one of our people. We can learn more about your situation, and we can start making some recommendations. But in your scenario, if the concern is loss, one of our biggest recommendations is going to be move a portion into FIAs so that it is still downside protected. But in most scenarios, it's getting a nice matching contribution. You can even get, like we talked about, we're using those guaranteed, those fixed interest rates for the first year a lot right now because we also are concerned about the economy. And then later on, what's great about FIAs is you can reallocate them. There's going to be, every company is going to offer a handful of different market indexes that you can tie to, and every company is going to offer a fixed interest account. And every year you can mix, match, blend, reallocate. So you're not stuck to one strategy to these. We can move it around, and that's something we stick around and we help you year after year on that. So Jeff, immediately you can move to the G fund. Secondarily, because of your age, you're 59 and a half and older, you've got unlimited other options. So definitely engage with us and we can talk to you about some other ways that we can not only keep that money safe, but get it growing better than what that G fund would historically. All right, great question, Jeff. All right, so this one's anonymous. Let me read it real quick. All right, so anonymous, do I understand correctly that we should allocate 100% into the C fund right now for under 40? That's not what we're saying. That's not a blanket statement that we would make. What Justin's saying is that any money that you want to have aggressive. So everyone has a different risk tolerance, and that's okay. Everyone has different time horizons. That's okay. Everyone has different goals and objectives. That's okay. So it would really be looking at what is your risk tolerance. If you're good with taking risk with 100%, you could allocate 100% to the C fund, and know that you got time to let that ride out. But we would need to talk to you specifically on that. But no, we can't make that blanket recommendation. All right, Patrick, how to move existing funds to FIA? Do not see this option on tsp.gov. Great question, Patrick. So it's called an in-service transfer if you're 59 and a half and older and still working. And it's just called a partial distribution if you're retired. So there is no specific option within it. It's a couple-step process, so I'm going to talk you all through that. The first step is identifying what company and what tools you want to use. And you have to create that account. So it involves, and this is something that we help people with, help you with identifying what's going to fit your goals, which ones, which is the best setup. And then we do an account setup where you actually fill out an IRA application with whatever company you're going to choose. And then will give you an account number, which is required. The TSP portion is a two-step process. And if you don't know, it's very weird and convoluted. But this is something we walk you through. You first have to notify them. You have to notify TSP of your new account that you've created. And then there's a 7-day account verification process. They won't even give you the option to roll that money over into an FIA until that verification process has been done. And then the second step is going back in now that they've, approved the account. Now you can actually request the rollover to happen. So I don't recommend trying to do it on your own. It's something that we can help people with. So Patrick, please get on our schedules. We would love to chat with you and figure out your goals and objectives and your risk tolerance, and then figure out, if and how much money would be transferred. We had another question that was just asking, how do I move the L fund to FIA? I just answered that. That was 2 birds, 1 stone. Here, 1 second. I need to get another drink. All right. So another one, same vein. Philip asked, you talk at all about rolling out TSP to IRAs? That was the process I just talked about. A lot of people had that same question. So, yeah, it's a little bit complicated, but we do it all the time, so we can definitely help with that. What is the custom build for L, Janie? So what we were talking about there, Janie, is that after we've looked at the history and we understand the structure of the 5 fund options, in our opinion, it really boils down to the 2 best funds are the C fund, if you're for money that you want to be risky with, just because its historical rate of return is so much better than the S and the I, the other stock market funds. And it tends to lose less most of the time than the other 2. And then the G fund would be for any money that you want downside protected. So here's a way where you can look at, of course, you could talk to us and we can chat you through this. But if you go on to tsp.gov and you look under fund options, and there's life cycle funds. If you went to the one that was the closest to, the date where you think you would retire, and you look at, it'll show you what the actual allocation is in that, and just basically mentally think anything that's G, you put into, you put in G yourself. Anything that's CS and I, that's the stock market allocations, and maybe even the F, you could just put into the C, because once again, historically speaking, the numbers say it's going to perform better if you just do safety to the G, aggressive in C, rather than having it split between the 5, because the F fund, the I fund, historically have severely underperformed compared to the C and S, especially the C. So Janie, please, engage with us. We'd love to chat with you, and we can talk to you more about that. Michael, who provides the 10% match for setting up an FIA? That would be the carrier, whatever company you use. So this is another really important thing to understand about FIAs. There are hundreds of companies that offer this structure of IRA, hundreds of them. We're independent. We're not tied to, employed by any of them, okay? What we do is we look at narrowing it down pretty quickly by just looking at the top rated companies. So we're looking at companies that have investment grade ratings, a long history to them, and stable financials looking forward. So that just wipes out, a lot of them. And then we're looking at the top 30, 40, maybe 50 from there. And then from there, we're going to look at actual incentives, features, rates of return. We break it down. There's 6 main characteristics of how FIAs function. We look at all 6 of those, and then we dial it down to a top 3 recommendation. And those are the 3 that we will go over with you on an FIA call. And this is where we get into the nuts and the bolts of helping you understand exactly how they work, and why we use them and how we use them. So really, it's going to be the 10% matches, whatever company you choose. Not all companies are offering 10% matches, right? So that would be, if that was a top priority, you'd say, hey, I want to find a company that has a 10% match. Great. We would show you, okay, here's companies that are offering that type of a match. All right. Oh, Patrick got onto the TSP website and said, hey, I see L income 2025, 2030, L35. Yes, those are the L fund options, and they range right now from L income, and there's one every 5 years up to 2065 as far as out. Here's another interesting thing about the L funds. BlackRock, even though they're one of the largest companies, one of the largest money managers in the world, there is no active management of your portfolio. There's no advice given. You can't call up and say, hey, give me some investment advice. That's not. TSP is a simple order taking platform. When it comes to these L funds, it's pre-programmed for the next 45 years. So it's not like they're reading the markets and the economy and adjusting those accordingly. It's just pre-programmed on how it's going to de-risk as you get closer to that retirement date. Great question, Patrick. All right, so Yolanda, question. I'm 59 years old, retiring in January 25, have a good amount of money in the G fund. What should I do? So Yolanda, the first question would be, if you're 59 and a half, then you've got lots of options. If you're not 59 and a half yet, you got to wait until you are 59 and a half or until you retire. And then at that point, you can transfer out and get into other tools and options. FIA would be a great replacement for the G fund. That's our favorite replacement for G fund. I was just going to say a follow on to that, and I forgot. So I was talking about that. Yeah, so that's the gist of it, Yolanda. You just got to wait till you're 59 and a half or older. If you're already 59 and a half, please talk with us. We'll learn more about you and your goals and objectives and all that kind of stuff, and then we can make some recommendations. But blanket statement, the FIA is going to tend to do a lot better than the G fund. That's why we like that in that scenario. Okay. Oh, I know what I was going to say. For those of you that retire prior to 59 and a half, once you're separated, you have all access that you want to your TSP. So if you're younger than 59 and a half and retired, then we can do all the TSP maximization you want. Once again, the chains and the gloves are off at that point if you're retired and younger than 59 and a half. Let's see here. Joseph got about 65% C. Should I move some or all out of GSI into C? Joseph, a lot we need to know. We got to chat with you about that. I can't make that kind of recommendation without knowing you and your situation, your risk tolerance, your age, your time horizon. So definitely schedule a free consultation with us. We can definitely chat with you more about that and look at your situation. It seems so. DeCarla says it seems the G fund is the go-to. So for age 44, G and C fund is the best for me. That's what we think. So once again, DeCarla, it depends on your risk tolerance. However much you want to be risky with, the C fund historically performs the best out of the risky funds. Anything that you don't want to be risky with, the G fund until you get to separation or 59 and a half, and then you're going to have access to more tools. But for now, focusing on those two and just looking at it. Here's another thing is when you do your own allocation like that, you do need to revisit it. I always recommend you can talk with one of us, or you can get onto TSP and look at your target retirement year. How much are they having in the G fund versus in the other four funds, and that can give you an idea of, okay, maybe every year or two I need to update those allocations, or the growth is different. If there's been large market expansion or large market contraction, you might want to still try to every once in a while try to stay true to what your appropriate L fund shows on risky versus safe. Good question, DeCarla. Donald, I turned 59 in September. Can we expect a market downturn this year or 2025? So Donald, I can't tell you for sure. I wish I had a crystal ball. Even the best economists in the world are wrong half the time. But what I can say to that, and the way I see this, is right now, all the ingredients are there for a market correction. Like Justin said, Jamie Dimon, CEO of Chase Bank, he sees that coming. He's feeling pretty confident about that. But when I look at election years as a whole bring volatility, I think this election year, regardless of what your political views are, I think we can all agree it's going to be an extra volatile year. It's going to be, a slugging match. Inflation's still not tamed. Interest rates are still high. The real estate market, both commercially and residential, is kind of out of touch with earnings. We've got multiple global unrests. Some of them are escalating. We have all the ingredients. We can't predict that. But I do think that if you are in the retirement horizon, especially if you're 5 years or less, if you're within that 10-year mark, I think it's a good idea to be prepared for or have a plan in place of, if we do have a market correction, how are you going to handle that? And of course, I would say talk with us. We can definitely chat with you some more. We learn more about your situation. Maybe have some recommendations there. All right, let me read this one. All right. Lewis, 50 years old, is it better to invest future or current balance to S&P? This is a great question because there is a difference and some people don't realize there's a difference. So let me cover that here. When you go into your TSP, you can change things in two fashions. You can change your current balance, which is called an interfund transfer. So up to twice per month, you can adjust your allocations of the balance. So that would be, I want to move, some C fund to G fund because I'm getting closer to retirement. That's one of your moves. That's called an interfund transfer. And there's also a place where you can change your new contributions because you can have those allocate in a certain way every other paycheck when your money's going in. So 50 years old, if we're assuming you're 10 years or more from retirement, you could probably have a good amount of your new contributions going to the C fund. But once again, it comes down to your risk tolerance, your actual time horizon. Back to talk to one of us, look at the L funds to see what that recommended, downside protection versus risk exposure is, and maybe adjust it that way. But yeah, no specific advice on that one because I don't know your whole situation. Patricia, I'm going to read this. This is a long one. Hang on one second. Okay, Patricia, these are great questions. So if I've left the federal service and I still have money in the TSP, can I move it to an IRA or deposit money into the TSP account? If I deposit money into the TSP account, will that money be tax-free? I'm going to tackle these one at a time. These are all great questions. So if you're separated, yes, you are free to move your money to outside IRAs. The only limitation in retirement is you can't do it more than once every 30 days. And that's any action on your money. If you take a withdrawal, that counts as that month's action. You got to wait 30 more days to take another withdrawal or roll money out to an IRA. Yeah, regardless of age, if you're separated, you have access to the TSP. You can roll it out if you want to. Can you deposit money into the TSP account? So there's no new contributions into TSP after you've retired. They do allow you could roll over, you could roll money into TSP. I wouldn't recommend that. TSP is an accumulation platform. It's really built to grow a balance while you work. Because of the limited fund options, I don't recommend rolling new money into TSP after you retire. Typically, we're going the other direction. We're rolling money out of TSP to gain more access, more control, more tools that we can use. If you deposit money into your TSP account, will that money be tax-free? So once again, if you can't put new regular contributions in, but if you rolled other tax qualified money from an IRA into TSP, that would be, still, tax deferred, get the tax treatment. Tax free, you're more thinking about Roth. So once again, it would have to be money from an outside Roth that you rolled into the TSP Roth. Then yes, that would be tax free. Here's another interesting thing about TSP in retirement is TSP does not allow Roth conversions. And for those of you that don't know what a Roth conversion is, it's a strategy that you can use to take your traditional pre-tax retirement dollars, and if you want to, you can just convert them into Roth, therefore making them, down in the future they're going to be fully tax-free, the principal and the growth. So people like Roth as they get into retirement because it's tax-free income. But TSP, first off, won't even allow that to happen. If you want to convert from traditional to Roth, you have to move that money outside of TSP to do it because they just don't facilitate that. The other thing to know about Roth conversions is it's very important to seek professional counsel on that, on when and how much money to convert. The reason why is because when you convert, let's say you wanted to convert $25,000 this year from traditional to Roth. Great. That $25,000 is a count towards taxable income because that money has not been taxed yet, and you're moving it into a post-tax account that'll never get taxed again. So the IRS needs to collect their portion, and so what they do is in the year that you do a conversion, it adds to your taxable income. So you will pay the taxes on that $25,000 in the year that you convert it. Here's what a lot of people don't realize is if you're still working and you're in a higher tax bracket and that 25,000 now pushes you into an even higher tax bracket, you're taking a huge tax hit to convert that money. So these have to be very carefully thought through on when, if, and how much money you convert so that you don't kick yourself in the shin tax-wise, and it doesn't take you forever to recover from that tax hit that you took. So normally, a lot of the times, it's either in a downed income year that you would convert or in retirement because your income's lower and you're in a lower tax bracket, so you pay less tax to convert it into raw. Great questions, Patricia. Thanks for those. Okay, Joseph, that was just a follow-up, almost 59 and a half. Have to wait till 59 and a half, Joseph. So definitely you can get on our schedules and we will be, we can get you all educated, fully up to speed on FIAs and which one you might want to use and all that kind of stuff so that the day after you turn 59 and a half, that you're able to go ahead and get that started. And so this is a weird technicality, but important to know. TSP's online system doesn't recognize you until the business day after you turn 59 and a half. And it's because of the way they do the updates on their system. So let's say that you turn 59 and a half on a Friday, then it wouldn't be until Monday that their system recognizes you as 59 and a half because it'll do the update that night. And then, they have to wait till Monday. Anyhow, yeah, Joseph, go ahead and, if you're within a few months, start chatting with us. We'll get you all dialed in so that when you turn 59 and a half, you're ready to pull that trigger and make that rollover happen. I'm reading this one. This is an interesting question about the defunding of the G fund. So you mentioned the issue of the G fund that the government was playing with the money therein, but if you moved part of your balance into CS or I, would there be a negative impact on the CS or I later? No. So it was just all IOUs. It was an accounting shell game is what was happening. During that divesting period, if you took a withdrawal out of the G fund, they would send you that money. If you rolled that money into the CS&I, they would actually roll it into the CS&I. Those were actually being funded. Basically, they were banking on the fact that there wouldn't be a huge run on TSP and everyone would withdraw all of their G fund or move all of their G fund out. If that happens, there would have been a problem, but that didn't happen. So it ended up being okay once they raised the debt limit. But no, Richard, so there's no long-term effect from that. Once they raised the debt limit, everything was made whole again and everything's fine for now until next time, because I can just about guarantee you they're going to divest again. Each time they get into financial trouble or they need more debt available, it's one of the big pieces that they can move is divesting. It creates a large amount of money that they're able to use without increasing the debt ceiling. And it seems like every time now they can't agree on it. Everyone's arguing and there's delays. So I don't expect that to change anytime soon. Let me read this one. All right, Steve. So some good talking points here. I reach MRA, minimum retirement age, in January, 56 years, 8 months with 30 years of service, currently in a mix of CNS, best strategy. So, Steve, a lot to unpack there. First of all, for those of you that don't know, minimum retirement age is based on the year that you were born. It's currently getting moved towards 57. Steve slides in just below that 57 mark. You need to have 30 years of service if you want to retire that early without any reductions to your pension. Best strategy, it seems like you're comfortable with being 100% risky. Like we said, just history says the C fund tends to outperform the S fund. There doesn't seem to be much diversification between the two. They're either up or down together. But once you hit retirement, that's when you're going to definitely want to start looking at not just having TSP, but using outside tools as well. And a lot of that's going to depend on what type of tools you use and what percentages you use on if you're going to continue to work or if you're going to be done and retiring and depending on this money as an income. Steve, please engage with us. We'd love to do a free consultation with you and learn more about your situation. Let's see here. Okay, Fatima, I have F funds. I'm retiring this month. Should I move to G fund or leave there? So, great question. First of all, once again, I sound like a broken record, but please do a one-on-one consultation with us. We want to make sure that all of your T's are crossed, your I's are dotted, that you understand the process of retirement, that your paperwork's filled out properly. All those things are important. Now, historically speaking, yes, the G fund does better than the F fund. If for some reason the bond market had a huge, shot up, the F fund could outperform the G fund. In that, it could happen if interest rates are lowered. Typically, when interest rates are lowered, bonds do better. But looking at the last 10 years, and especially the last 4 years, the F fund has not done great. So yeah, you definitely could move into the G fund, but more than anything, engage with us. We can learn more about you, and then we could make some more specific recommendations. But yeah, my biggest recommendation would be that you probably start moving some money outside of TSP to gain access to more tools that are out there. So Lewis, that might have just been misspeaking. We're live. So said, you say S, I, and F are not good investments. Then later you say I is good. We didn't mean that, if that was said. So the international fund, it gets used pretty heavily in the life cycle funds. But when we look at just the history of it, it is less than half of the performance of the C fund, barely more than half of the performance of the S fund. The I fund, it can make more in a single year than the C fund. It also tends to lose more in a single year when markets are bad than the C fund. So historically speaking, the I would be inferior to the C fund. Same thing with the S. S is more respectable on its historical averages, but it's still, considerably less than the C fund over the long haul. So sorry if we misspoke, Lewis. That's not what we meant. Let's see here. All right, Alex saying I'm 64, hoping the market will be better in the next 3 years to put my funds in the C fund, then invest later in FIA. Should I put it in FIA now? It all depends on your risk tolerance. So I, definitely, if we look at historical advice, if I'm assuming you're meaning that you're 3 years away from retirement. Just to benchmark this, like the L 2025, which they say if you're 25, 26, 27 retirement date, that would be the most appropriate fund. That has about 60% in the G fund for protection. In that case, whatever amount that is, if it's 60% for you, or if it's 70%, or if it's 40% that you want safe, I would definitely say, an FIA would be good for that sooner than later, especially because we're seeing such big incentives right now from the FIA companies. But yeah, definitely engage with us, Alex. Let's chat, do a one-on-one consultation. We can learn more about your situation and make more of a specific recommendation for you. Let me read this one. Okay. So Cheryl, until I can set up an FI, what should a conservative fund balance be to grow and protect? For example, C fund 60%, S fund 30%, I fund 10%. By the way, you're 60. So Cheryl, you're eligible now to start doing rollovers. So definitely get on our schedules. We want to chat with you about what percentage would go FIA. And a conservative would be far more G fund. So the most conservative L fund they have, the life cycle fund, is the L income fund that has about 70% downside protected G fund and about 30% in the stocks and bonds. That would truly be a conservative fund. So in that scenario, like we showed that slide, if you're only available inside TSP, you weren't able to roll out, you could mirror that in a stronger fashion and do 70% G fund, 30% C fund. And historically speaking, that would outperform the L income fund itself. but that would be considered conservative, 60, 70% G fund or FIA, and 30, 40% market allocation. Definitely get on our schedule there, Cheryl. Yeah, so Donald, his question is, do you have any recommendations for those of us that will only keep maintained funds in the TSP? I don't want to move funds outside of TSP. That's what we talked about is within TSP, when we look at the history to those, you really want to focus typically on C fund, G fund, because G fund is your only downside protection. So that's where you'd put any money that you don't want to lose, because none of the other funds are going to protect that. And out of the CSI and F, the C fund stands head and shoulders above the other ones when we look at the last 10 years or even all the way back to inception. So yeah, we talked about this multiple times. For those that only have access to TSP or only want to stay in TSP, that's what we would say is look at the history, look at the data, and say, focus on the strongest ones. And G fund is the only way that you can offset risk. There is no other option. Let's see here. All right, so I'm actually at 31 minutes past. I got to wrap up. I've got another appointment to get to. I got so busy answering questions, I wasn't looking at the time. I've got a bunch of questions that I didn't get to. I'm sorry if I didn't get to your question. We will get back to you one way or another with those unanswered questions. We do reach out here in the next few business days. Thank you all for being here. Thank you, like I said, for keeping this country running. We really appreciate you. We look forward to talking to you one-on-one. We look forward to seeing you on future group trainings like this. Be safe, everyone. Be kind, and have a great weekend. Thanks, everybody.